Hi, this is Randy Finney with the Right Side of the Chart, and this is a closing market wrap for the week ending Friday, July 17th, 2020. I'm going to do this one a little bit different. I will start out, as usual, covering the broad markets, S&P 500, NASDAQ 100, small caps. Then I'll roll in. I have a watch list that has various indexes, sectors, even some international ETFs, and I there's a lot in there. I flagged about, looks to be about a dozen and a half actually, maybe. And I'll go through those to kind of paint a bigger picture of what's going on, not just here in the U.S., also a little bit around the world, mainly China. There's a couple Chinese ETFs in there that I flagged, and also some of the sectors that I'm watching. So let's start out here with the S&P 500. Not a lot to report when you're only up, closed the day up 0.29%. The story is this: we have this multi-week, almost, it's over a month-long now, trading range. I probably should move that orange box up. This is it. We had that island cluster top right here. We put that in, and we've so far failed just shy of it, but for the most part right around there. So that's it. Goes back to, I think, July 11th, the top of the previous peak here, and I want to point something out with the equal weighted S&P in a second. It's actually the 8th, June 8th right there. So we closed today below where we closed all the way back on June 8th. Same story. Market's not going up, but it's not going down either. It's been locked in this trading range. I would say not much different from this one. It looks to be about the same period of time. That one broke to the upside and gave us this next thrust up. So we still need to see which way this one breaks. Now, something to note. Okay, so you can see, and I'll look at it, show you here on the S&P 500 itself. That's the tracking ETF. Same story. We have this box right here that shows you the broad market. The S&P 500 is, struggling with where it capped out back on June 8th right there, a little over a month ago. Stalling out, volumes starting to taper off a little. That's usual for this time of year too. We're in the summer doldrums. Now look at the S&P 500 equal weighted index, telling a different story. Here's our June 8th high, and we're still well below this. This jives with everything I've been talking about with the breadth deterioration. When you apply an equal weight, you take out the overweighting, because the S&P 500 is a cap weighted index, meaning they give a bigger percentage, just like the NASDAQ 100 does, to Apple, Amazon, all the big names like in there. And so therefore, what you've seen, if you take out the effects a lot of the big mega caps have had, then you see it's really telling you a different story. We're still off the lows quite a bit, off that recent spike high right there. In fact, if you look at this, the equal weighted S&P 500 is still off as of today's close, about 11% off its all-time highs back from February, whereas the regular S&P 500, which is market cap weighted, is, I'm going to need to move that to grab the top of that candle. We're only about 5% or so. You can see that. So again, that's the impact. Now, what does it say? Well, look, one good thing, if you have your money in S&P 500 index fund, great. Who cares? You had the outperformance because of those bigger names. But again, it speaks to what I've been talking about, a deterioration in market internals. And you can see it here in the NASDAQ 100 as well. Let's just start out with QQQ. Bearish engulfing candle on, was it Monday? Yep, Monday's bearish engulfing candles. So far, no confirmation to those. So to me, that's only a potential topping stick. Still very much in play. We remain, actually closed down around the bottom of that candle today after failing to take out even the midpoint. So it's still a potential topping stick. But just like, we had some sell signals on the S&P 500 almost a month ago, and we just traded sideways after that. I'm referring to those island cluster tops and the breakdowns here. Let me show you if you're just catching up. This is what I'm referring to. So you got to give it to the market. You had a big gap down right here. This candle right here, I'm trying to box in below this uptrend line. The same day you gap down below the island cluster, but instead of falling through, the S&P 500 has been moving sideways. So same thing with the NASDAQ. The Qs really aren't going so far since that breakdown, or I'm sorry, since that bearish engulfing candle. That's all it was. I don't have any trend line breaks or anything like that. We're just moving sideways, so that's it. Let's look at the NDX real quick. NASDAQ 100. What's interesting as well is I draw the NDX, and this is the index that QQQ tracks. So you have the same weighting, the same exact stocks. This is QQQ, just the what you trade. You can't trade an index directly. That's why they have proxies such as ETFs, futures, options, things like that. So here's my trend line, or my what I see on it, and I see a nice parallel price channel right now working its way up on the NDX, NASDAQ 100. Same bearish engulfing, very much still potentially in play. Just need that confirmation, and as I've been saying, since we don't have any follow through red candles, that one's not enough. We need to take out Tuesday's lows. That'll do the trick. Taking out Tuesday's lows will also have taken us below the trend line, so I would put that as a very solid sell signal if and when we get it. So that's what I'm looking for next week. Again, if you break Tuesday's lows, you're also going to take out this uptrend line, this price channel. Why am I not looking? And look, here's the flip side. Bulls want to see the top of the candle get taken out, bullish. But why am I not leaning towards that scenario? This tells me everything else, what's going on in the economy, just like we had negative divergence leading up to this high right here. The charts indicate that this has been a strong rally, just like the one leading up to that high back in February was, but it's losing momentum. The momentum is waning, and these divergences are not perfect, but they do a pretty good job, well over 50% of indicating that an impending trend change is coming. You just need the sell signal to get there. Now, what looks a little different here is I pull up, remember, look at this price channel. Now I pull up the NDX equal weighted, and I have a different thing. I can't draw a price channel here. I can't make an even parallel trend line right here. Why? Because it's again a different story. The same thing that thrust up on the NASDAQ 100 after this candle right here. We had a pullback, and we'll use this one right here. We had a thrust from that reaction low of about 14% on the NASDAQ 100. At the same point in time, that same candle right here, the date was, I'll give you the date, June 29th, we have a thrust up of only about 8.76. And again, that tells me, or it's hard evidence, that the heavy-weighted, big beloved market cap stocks are, extra large. We call mega cap stocks. Is what I'm trying to say. Tesla, Facebook, Amazon, Microsoft, Apple, they did most of the heavy lifting, but they've also showed some cracks recently. We need a little more downside, a little more work, although Amazon, I'll get to that one in a second, is clearly looked to me like it's top, but you need the rest of the big fangs to come and give you some sell signals to confirm. So I'm going to put a line here for the equal weighted NASDAQ 100, a little support level I see. You broke out of that previous high, and so really on the equal weighted, if you take all 100 stocks in there, give them equal weighting, they basically have just recently broken out above their all-time highs right here, the previous all-time highs, and that breakout is intact right now, but it's like I said, it's questionable. If we break down, and when you break below 48.91, same thing. If you break the trend line, let's keep it very simple. If you break Tuesday's lows, that's going to do the trick. It will give you a breakdown of this bearish rising wedge. As I said, the technicals are different on the equal weighted and the non-equal weighted NASDAQ 100 because of that, because of this underperformance. The NASDAQ 100 equal weighted is all the way up here. That's why I have a price channel drawn like that on the NDX. So I thought that was interesting, and again, it just helps illustrate what's going on right now as far as the internals in the market, and that's not unusual to see that towards a top. So call it what you want. We don't have the sell signals yet, and that's what I'm watching for next week. Keep it very simple. Break of Tuesday's lows, going to break this big bearish rising wedge. This is, as I've mentioned recently, the first time since back in February we have negative divergence on the major indexes. We have it on the S&P 500, we have it on the NASDAQ 100, QQQ, clear negative divergence, which on the daily chart is usually good for a multi-week swing trade, if not a trend change. You usually get major trend changes when you get bullish divergences at the lows and negative divergences at the highs. IWM, I mentioned it broke above. Again, I have a range, and my number says 145.08, but it's 145 to 146-ish, and we're at 146.59. Why? Because we had a reaction high there that was a little bit above there. There's a 200-day moving average. I don't know if you can make it out. This blue line right here comes in right where we're at. So we did pop up, and we're holding that breakout, but it wasn't very impulsive. This is what I'm referring to. And B, we haven't seen any follow through. So, for the time being, I'll give it to the small caps. They have that breakout. If it sticks and they can start to build on it and walk away from that level, great. That's, like I said, if the market holds up, and the Dow and the S&P 500 and everything rise, or continue to move higher in the next few months or so, I think you'll have more bang for your buck on IWM. Otherwise, if it fails, it fails. And again, that level is there because we can go back quite a bit in time here over the last few years even and see numerous reactions on that level that have defined that 145, 146, even all the way back here as well. Now we're in 2017. Now what we're going to do is a little bit different. We're going to change gears. We're going to go into weekly chart mode. I might toggle back to some daily charts, but this is where I wanted to cover some of the other things that I have flagged. They're not going to be any particular order because I sorted them by flagged items. In other words, there's too many items that list to cover them all, but we're going to start out with IWM only because we were on that one, and this is gives you the big picture stuff. I think it's very easy to get tied up in the day-to-day, moves of the market, short-term bullish trends, bearish trends, volatility, things like that. And I think it's very important to take a step back every now and then, look at the bigger picture. And here's the bigger picture in the the small caps, Russell 2000. It effectively put it in a double top. Technically, the small caps peaked back in 2018. That was the high, and that high was a little lower, but for all intents and purposes, close enough. So that is a double top right there, big resistance. We're still well below it. The small caps entered a bear market, and by almost all metrics I have, they're still in a bear market. Yeah, it's been one heck of a rally off the lows, but again, only commensurate with the magnitude of this bull market, this liquidity injected financial system that we've been in since 2008, 2009, with all the central banks, keeping the pedal to the metal, and so we say this is my one word for the bull market from '09 up until really today, if you want to call it that, is supersized. Bigger rallies and bigger corrections along the way. Even these are all technically bear markets, but call it what you want. So there it is, double top high. Primary, I have alternative trend lines. I couldn't draw one off the '09 lows. That it just doesn't mesh well. So I have one trend line here. They both come in together, and they catch a lot of reactions. And so I just have the small caps breaking down, back testing. Again, bigger picture. I have this trend indicator here, still on a sell signal. I'm referring to the PPO signal line, the 9 EMA. When it's below there, is boxed in red. That should be here as well. The trend is bearish. And when the PPO signal line is above, the trend is bullish, and you can freeze this screenshot, go back and see that usually works. And nothing goes down forever. We came overbought. The Fed came in completely nuclear, to support the markets from that point. So I think it's just given a little extra juice to what would have been a bear market rally that would have came no matter what. Just might not have carried up so far or so fast, really. But that's where we are in IWM. Okay, we're going to go through the rest here. Anything interesting, I'll try to toggle over to the daily charts. Just take a look. IYT, this is an important sector. This is the transportation. It's kind of a canary in the coal mine. Tells you how the economy is doing. If the transportation sector is not doing well, there's a whole Dow theory that says when the Dow's making new highs, if the transports aren't, then there's an issue there. Well, of course, the Dow's not at new all-time highs, but what I can tell you on the transport simply is that they're at a pretty decent resistance level. I'll zoom in a little tighter. It's this level right here. We've had a couple breaks below, and again, I'm a firm believer that the U.S. And global economies would have been in a recession back in 2018, but we've had excessive Fed intervention. They started to back off and try to wind back some of their easy money policies here. The market threw a tissy fit, as I said it would, and as I said they would pull a complete 180 before they did it, and that's exactly what they did there. From going from hawkish, meaning raising rates and talking about higher rates to come, to completely dovish. So they gave the market a stay of execution. The Fed has just refused to let the natural process of recessions and economic expansions, the business cycle, they refuse to let it happen anymore. I think long term that's going to have unintended consequences, maybe stagflation, things like that. Like same thing happened back in the 70s. We'll see, but that's it. Let's look at the technicals again. It's that level right there we're coming up to. We already failed at it once, and that's what the transportation sector looks like. Daily chart. You can see it here. This is a very busy, messy chart, but I'll just box in what's relevant, and it's kind of that same level I just showed you there. If you box in here, we had this trading range in the past few years. Here the year breaks down here, 2017, 2018, start of 2019, 2020 right there. So just a big, it looks just the end of a long, decades long plus great bull market. One that has tried to get going. The Fed just wouldn't let it die. But by all metrics, again, IYT, the transports are in a bear market. They broke down after this major topping pattern. That was a very clear major topping pattern. They broke down again, and they've come and back tested. So that's it. They're at resistance. There's a trend line right there. Look, if they can power on up through and into, and especially above the trading range, great. Then guess what? This was probably one of the shortest bear markets on history. That'll go down the record books as undoubtedly the strongest for such a short period of time. We're talking just from February into March right there. But again, we'll see. All right, moving on. Next one, gold. I did an extensive video on gold recently. Gold is, as I said, divergence across the board. Needs to take out this 168.70 level to give us a near-term sell signal. We had that red candle yesterday, but no follow-through, and it wasn't a very big or impulsive red candle. So I'm still looking for. I'm becoming increasingly bearish on gold. Might start adding some shorts to individual stocks, ETFs, things I've covered recently there. I'll get to some currencies in a second. We can, I can paint both the bullish or bearish picture on the currencies. I'll tell you what I see. We are at some key inflection points, or technical levels, I should say, that could prove to be inflection points. Let's go on to XLB. You know what? I didn't do the weekly chart on gold. Told you guys I'd stick to the bigger picture. That's the bigger picture. And gold's coming up to what's been for a long, long time. My initial bull market target there, right there, about 174-ish. So getting very close, but we continue to diverge, and that's why I pulled the trigger and closed out the official long yesterday, because we're only a couple percentage points from that target. Like I said, it seems to me good chance we'll get a correction. I doubt we'll just blast on through there and keep going. Anything's possible, so I'll adapt and adjust accordingly. All right, next up was XLB. Yeah, this one doesn't move the needle on the S&P 500. It is one of the 11 sectors, but it only has about a 2.5% weighting. But it kind of gives you an idea of what's going on in the economy. And these are basic materials. Almost everything's been gunned up with the Fed's nuclear actions that they've done, the steps they've taken here to shore up companies in the market and the credit system alike. But all I can tell you is 61.20, or give or take, is just major resistance for going back for years to 2017. We had a little brief pop above that level, and then you can see for years this is where the basic material stocks falter. Can they bust on through there? Yes. The odds, from my experience, when you come from such sold readings to nearly overbought, having such a move like this off the bottom, again, due to the explosive bear market rally, 63% in the basic material sector. When you go do a 63% rally, the odds of breaking up through resistance and then continuing to run without at least coming in a back test or that breakout failing, to me, is extremely low. In other words, the basic material stocks have spent a tremendous amount of fuel or energy to get to this point, and they got there really quick. So at best, I think they stall out here, and this is a kind of common theme I'm seeing in the market, and that's why I'm going through all these different sectors that they're at big resistance. And again, can they take it out? Sure. But when you go back in history and in time, you're usually not going to see a 63% rally just keep going like it's not even nothing stopping it. You're going to come up to that resistance, and chances are, meaning well over 50% chance, that we're going to have to consolidate here at best, for a little while before breaking through. And at worst, we reverse and move down. Semis. I did a video on the semis recently. They are very much on my radar. When the next decent correction, I'm talking 10% or more in the stock market comes, I think you're going to have a lot more bang for your buck shorting the semis. This is DJUSSC, the Dow Jones US Semiconductor Index. I might have a couple ETFs in here flagged as well, but simple stuff. I look for these divergent highs and divergent lows in the semiconductor sector. Pointed out divergent lows when the time's right in the past. That's it. And you get these breakdowns in the semis. The trends in the semis are powerful. So you get these, we already had a breakdown. We had more than a back test. Again, I think this is momentum fueled overshoot. I think it's a boost given by the Fed. Had the Fed let nature run its course, natural business cycle, economics, supply 101, demand, then I think we probably would have reversed there. However, I think they, shot a little too much adrenaline into the patient. And by doing that, yeah, they're going to jump up from the ground. Eyes are open. They're going to wake back up, but you're probably going to stop their heart. So I think I don't think it's going to end up being a good thing. And again, let the chart speak for itself. Maybe I'm wrong, but you go back in time. Look for these divergent highs, and the drops, the trends in the semiconductor sector are pretty powerful. There's 30% right there on that drop, 25, and that's in a bull market. Now you find a trend in a bear market in the semiconductor sector, and you're talking 85% drop. That was the 2000 to 2002 bear market. Here's the last bear market, talking about a 66% drop, which was more than the overall stock market. So again, a lot of bang for your buck in the semis. And across the board, just about any time frame, that divergence is still very much intact here on the daily chart, which I just flipped to. Bearish rising wedge pattern, but you need to break the trend line. And like everything in the index, is basically if you break Tuesday's low from Tuesday this week, that'll be it. So that's where you might want to set some alerts on some of these key stocks and sectors. All right, next up. Talking fast, I can move through all these. I already covered IWM. Euro US dollar, okay. I've been longer term bearish on the dollar for a while now, and that means bullish on the euro. But here's what we're looking at on the long term chart. The euro has this basing pattern. It's a multi-year basing pattern back in 2015 to 2017. Broke out there, rallied up, put in a divergent high here, corrected. So that was significant, very significant resistance. And once we broke it, we back tested, and finally fell below it. So it's still resistance, as well as this primary downtrend line right here. This is a very big, this is, the primary downtrend line here for the euro right there. And it's somewhat above. So here's what I'm thinking. Longer term, the euro looks bullish. It just put in this divergent low right here, as I mentioned, and it's been moving higher. But we're coming up on significant resistance around 115. If they take that out, then it still has additional significant resistance just above. So I think the upside in the euro is limited, and for the very near term, maybe longer term. And I think if we get a correction, if it's off here or here, I think that will, and it should, bring gold and silver down, and GDX, everything else I covered. Because remember, the euro, or we're looking at here, the pair, the euro US dollar pair, when this is going up, the euro is rising and the dollar is falling. So that's what it's showing us. And gold is very much a dollar sensitive asset. So a falling euro, which means a rising dollar, is net a bearish thing for gold. So that's what I wanted to cover on that time frame. I already covered the S&P 500 equal weighted, but more so in the near term. This is a longer term chart. Here's a trend line there. There's our divergent high right there. Big negative divergence before the February drop. And what I've been saying all along, I still believe this is most likely a bear market rally. It's a big rally, yeah, but it was coming on a big drop, and it's coming off a huge, one of the biggest bull markets and the longest bull market ever in history. So the corrections have just gotten a lot larger now because of the the magnitude of these waves. With this liquidity-driven financial system that we're in now. FXI. This is one of a couple Chinese ETFs I have in there, popularly traded one. And this one's at resistance. You can see quite a bit. We're on a weekly chart again, and you can see just over the years, there's been a lot of reactions. When we broke it here, and that was a false breakout. I marked it at the time as a blow off top buying climax. We rallied up, had what I call momentum fueled overshoot. The breakout failed, and nothing, fewer things in trading are more bearish than a failed breakout. That whacked, FXI, brought it all the way back down here, and that was back in 2015, 2016. That wasn't, when the U.S. was in a bear market or anything. What happened? We did the same thing there. Popped it on what I said at the time, blow off buying climax. Couldn't hold the level there, tested it for a while, so that shows it was a very valid level. A lot of traders are watching it because they stepped in and held it there, but you also finally gave up at the same time. You did two things. You broke that 45, I should make it, round that off, call it $46 support, and the uptrend line, boom, and that sent us down back to that 39.30 support. So all I wanted to say is, hey, anything's possible. We can blow on by there, but this has been a pretty strong run off the bottom into resistance. Again, common theme with so many individual sectors, and again, this is halfway around the world, of course. All right, next one up would be XLK. I've covered that quite a bit recently. XLK, big thing is a daily chart here. We had the bearish engulfing candle as well on Monday. No follow through yet, plus we have trendline support. So same story, you need to break the Tuesday's low about 103.87 to get a sell signal. Otherwise, the trend's intact for now. And it's things like this big negative divergence on the weekly chart that says, hey, we're probably looking at more than just a little correction coming once we get the sell signals on the daily chart, just like back here. Trend seems resilient. About this point here, nobody wants to short anymore. Everybody wants to be long, and that's usually when it ends. And that was the last sell signal in XLK there, or not the last one, but back then. Another trend line break right there. And the thing about crowded trades, everybody loves tech. They've loved it for years. Tech has changed the world. There's no arguing that. But when the herd exits, when there's a stampede for the exits, they fall fast. So you can't sit and wait too long once those sell signals come, because the moves. But if you wait just a few weeks, sometimes a couple days, you've missed an objective entry, and in some cases you missed the bulk of the drop as well. So I'll be watching for those sell signals, and there's plenty of meat on that bone. I think we come in again. I know we recently checked the long-term trend line right here. That was the last check of the trend line on the drop into the March lows. But I would be looking for that as another potential swing target the next time we get a decent sell signal. And I'm talking, that's the bull market trend line that comes all the way off here in the lows back in '09. S&P 500, I've showed you SPY, and it's the same thing on the weekly chart. I've showed you in the past on SPY. We have a big, what appears to be a big megaphone pattern, aka broadening wedge pattern, and that's it. We're within that pattern, and should that play out as a topping pattern, it's big. And if you look at the scope of that pattern, it would just say, wow, bad things to come. If it plays out, there's no sell signals within it. It's going to be a long time before we even get to, if we do, to the bottom of the wedge and then break it. There's a strategy called a partial rise strategy I mentioned before. You short anywhere from about a 50% to 61.8% retracement within the wedge to look for a break to the downside. But again, let's wait for those sell signals on SPY on the daily chart. No reason to try to guess where this thing's going to reverse. If it is going to reverse, that's what the daily charts are for, and the 60-minute charts. You can zero in on more accurate entry points than we can on the weekly chart. Because if you wait for sell signals on the weekly, those usually entail weekly candlestick closes below key moving average or trend lines. And here's a good example. If you waited, this yellow trend line, you waited for a weekly confirmation, well, guess when you shorted? You shorted exactly 9.3% below where the breakdown point occurred. Whereas if you were trading on the daily chart, you would have been able to get in much closer there. And when you close a week down 9-10%, I can just tell you this now, I've done this long enough, most people don't want to short. They think they missed it. They think that's it. They're going to wait for a bounce back up here or somewhere, and they never get it. The market will usually deny that. That's what happened back then. So it's sometimes when there's a solid breakdown, I don't mind if I didn't get an ideal entry if I think there's more downside, or I'll take a partial position, and great, if you get the kickback, you add. And if it keeps going down, hey, you've got some in there you can add on a position that's now profitable. PGJ is another popular Chinese ETF. And that one you can see on this weekly chart. We had several highs back here around the 50, 80-ish level. We'll call 51 back then in late 2017, early 2018. Came, hit the trend line, hit the trend line, hit the trend line. Broke the trend line during the meltdown into the March lows, but then quickly snapped back above it. Just recently took out, in fact last week, took out the 50-80. So that was a breakout. However, very big bearish engulfing candle. Bearish engulfing candle only has to engulf the body of the previous candle, not the skinny part, not the shadows. And that's a clean bearish engulfing candle. Now, we're only back testing the breakout point. So and just like the bearish engulfings that we got on Monday in the indexes on tech and XLK and QQQ, we need to see follow through. So that's what we'll be watching here. And that if we get that, that'd be a pretty powerful sell signal on this one here, PGJ. There's also a trend line it would take out as well. So there's one to watch if you're looking for a short trade idea. And if you're a bull, if that whole I tell you right now, if you're a bull, go long. You can, markets are closed right now, but you buy a pullback, it broke out, and you buy a back test of support. Resistance once broken becomes support, plus your trend line support. It's very objective. It's just not the type of objective entry that I'll take because of a bearish engulfing candle and a pretty impulsive rejection or reversal after the breakout. So that's PGJ, and we'll look at the daily chart. You can see something similar trend line actually. I'll clean that one up and do it like that. That will match the trend line I just gave you on the weekly right there off the lows. And so that's what needs to break. And there's those previous highs right there. So you can see this is, we're on a daily chart now, but the same level right there, about 50.86 or so. And where will it go if it breaks down? I would target at minimum that previous reaction high right here. Again, bare minimum. And I'd have to sharpen my pencil to look for other targets. We'll just see what happens next week. SPY already covered. SMH, I touched on the semis, but I can go through these. There's different ETFs that cover the semiconductor sector. They all have a different basket of semis, different weightings, but the same story. You have these divergent highs right there. Divergent high before that big breakdown. Negative divergence here. There's a pretty clean trend line. And same story. Tuesday's low should do the trick. GDOW, this is the global Dow. So if you want just one single index, it's kind of telling you what's going on around the world. This one's about as good as any, and you can see we have a pretty clean trend line right here working its way. There's that previous reaction high, and a lot like I showed you on the equal weighted S&P 500, it's lagging back behind that high, that peak high in early June right there. If we can power up next week, any more upside to equal or slightly exceed that high, will be a divergent high on global Dow right there. You can see last time we had negative divergence was before everything fell off a cliff right there. USO, not much to talk about it. The CL, the crude futures, is starting to play out the divergences I've been highlighting there recently. USO this is one of the more popularly traded, more liquid ETFs that track crude, or ETN technically speaking. Big old gap right there, and the top of that gap has just contained all the advances for a couple months now. So there's not much more to say about it. If it pops that range, 30.42 would be your next big resistance level. But based on the 60-minute charts, what's going on there, I think we go down. QQQ, already covered that. XLF, I've covered this recently. The financials are kind of just grinding around, still well off their highs, telling you something is not right. Financials are in a very important sector, probably the most important. I mean, if the financial system collapses, that's more. Tech might be bigger; it has a bigger weighting in the S&P 500. But the whole financial system is a house of cards built on everything the central banks, the Fed, and the banks do. So, anyways, it's somewhat of a tell, is what I'm trying to say, that the XLF is still well off its highs right there, 24% below. I did a video just a couple weeks ago comparing the divergence between tech and XLF. and this is so far the biggest divergence that they've had since right before the Great Depression back in 2007 into that 2009 bear market. The financials were a tell. They started diverging from the rest of the market, particularly the tech stocks, which kept soaring right up into the 2009 or 2007 highs in October of '07, whereas XLF was already starting to go a different direction. So again, it's this divergence that I'm watching. Banks are starting to report now, and so far fairly lackluster movement there in the financials. Probably should have went to the weekly chart like I was talking about. By just about all metrics too, they're in a bear market. That's where I think a lot of people lose sight. I think they get tied up in both the magnitude of the rally that we've had and the fact that tech stocks are making new highs, whereas, as I've said recently, nothing else is. In the S&P 5, there's 11 sectors, and only the tech is the only one that's gone to new highs. Everything else is still well off the highs, just like the financials here. And every trend line, all the long-term trend lines that I have, XLF is still well below that. So here's a sector clearly in a bear market rally, at least to me. Only hindsight will tell if that's the case. In other words, I can call it a bear market rally now. You might call it the start of a new bull market. If it does this, you're right. If it does that, or anything, anything keeping below that previous high, then I'm right. XRT, a lot of buzz about retail, how retail is coming back to pre-COVID levels or close to it. Retail sales are up. Well, retail sales are going to do what they're going to do. I'll give it, tell you this, that the consumer sentiment and the stock market go hand in hand. Fed's gun the market up, sentiment's up. They've thrown out, for those of you in the market, those of us in the market who listen to my voice, probably in the market, there are a lot of people, a majority of a lot of Americans aren't. They're at that levels where, they're more concerned about making their, rent or buying food this month. They're not in the market, but guess what? They've got, big fat checks to spend and extended unemployment benefits. So, everything the Fed did is working, but what did it do? Forget about what's going on fundamentally. XRT has rallied right into resistance. What I see here, let me just show you, because sometimes I'm talking about this stuff and it might seem very clear to me. I see a few trading ranges here, several trading ranges, and we're going back for years. So this is early 2013. And there's been, of that, really one big trading range, let's just call it. Of that big trading range between 38, I'm going to round that off, it's bugging me, it's so close, 38 to about 46.40, we've had 3 whipsaws. We had one brief period where it broke above, and as I've often said, and you heard me say this today, earlier, and quite often, breakouts that occur with negative divergence have a much higher rate of failing. That was the breakout. There was your trend line. So that breakout above that range failed, took us to the bottom of the range. Then once again, the retail stocks tried to power up. They did. They took it out, but they did it with negative divergence. And again, this is just, I don't know, doesn't always pan out, but it seems like pretty simple stuff. It's just avoid those breakouts that occur with new highs. In fact, don't avoid them, embrace them. Look for sell signals. You can't short it just because you have divergence, but you wait for the sell signal, and then those are your trading ops there. Now, we don't have a breakout yet, so I want to say that. We haven't broken out, but we've rallied into resistance. So other than that, TA 101 is short rallies into resistance, or sell your longs if you are long, and either or. If you're short, you put a stop just above, because 2 things may happen. Maybe a breakout like this, and it may be proved to be a failed breakout. But guess what? This breakout lasted, before we fell back down below there, that was 8.3 months. We had a little whipsaw there. Let's just count this one. That still took about 6 months. So, and percentage-wise, it was pretty substantial. So, if you do take a shot at the retail sector, that was a 13% rally. Best thing to do is put a stop a little bit above, ideally on a solid closing basis. That usually does a trick, no guarantees, but if they can close the week with a solid green candle, especially 2, then that's going to be bullish. Up until then, I see this as a rally into resistance, downtrend line, everything else. You can see it here on the daily chart, quite a bit of resistance. So one of the better looking sectors, throw in negative divergence on this daily chart as well to boot. And you're looking at one of the better sectors. So next week, what I'm going to do is go through the watch list of all the retail stocks because I like to do a top-down approach. In other words, identify a bullish or bearish sector, then within that sector drill down and find, if it's a bearish sector like this, find the most bearish looking setups, and then focus on those for trading up. So I'll be doing that next week. Almost done here. Brokerage, I figured this one was worth mentioning. It was in my list. I see some resistance here about 36.21. This is the investment brokerage, national investment brokers. So these are your big brokers, like Schwab and those type of companies, not your little smaller ones. Look at XLE. There's not even much to say at XLE. The energy sector has been in a bear market since 2014 and still clearly in a bear market. This has been at least by the look of this chart and every other metric, nothing but a bear market rally. In fact, look where it rallied into. The 200-day moving average is also the 40-week when you put it on a weekly chart, and that's been capping the advances here for years now. All of 2019. There was a period where we traded through it, but sometimes you get these stronger downtrends right there, and it caps the kickback rallies. You get above it, it's bullish, it's support, and then you get below it again, and it's resistance. So that's where we're at right now. We hit it, and we've been rolling over since. Last one, and then last but not least is the airline sector, XAL. It's the Amex Airline Index, and I've had this line here for quite a while. It's 73.61, and it just shows you the bigger picture of the airline stocks on this weekly chart here. You had an uptrend line right there, bearish rising wedge pattern, and this was a support level back then for quite a while. We smashed through it there. You also have that 40-week, which again is a 200-day moving average. We came up and kissed. It was not by mere coincidence when the 200-day was taken out, or the 40-week right there. That's when the bottom fell out of the airline sector, and we rallied back up to it, and we were rejected. So now, what would I do here? I wouldn't short or go long. We're in no man's land. No man's land is when you're between support and resistance. I'm just showing you these levels, kind of painting the bigger picture again, that these guys are in a bear market. Oh, I had a reason for this as well, the box. If you look at this, you can see that we started the bear market back here early 2018. That's when the airline sector topped. They were already moving down. Just the bottom fell out here. COVID kind of aided along the bear market with an impulsive move down. Kickback rally to test that 40-week moving average, and been moving lower so far. That reminds me a lot of this period back here. We'll zoom in a little tighter. Here we were back in the early 2000s. We'd already topped. The bear market was back here. The bubble burst in the tech stocks around right here, or this peak right here, that early 2000, March of 2000. So that's when the bear market started. It started slow. We were going down. Then finally, impulsive move down. Yes, that was September 11th back there that caused that. But take it what you want. People dismiss this. Oh, well, that was September 11th. Oh, this was COVID. No. Once the wheels are in motion, fundamental things come into play, and that's what happened there. So you had a very impulsive move down, a nearly identical kickback rally in scope and everything. I hadn't measured it. Let's do that now. About 78%, right up to the 40-week moving average, and then boom, the next leg down came. So again, that was then. This is now. Rally after the impulsive leg down, 121%. A little bit bigger, but then again, so is a drop. Remember, everything is supersized, a la the Fed and other central banks. So the drops are going to be bigger, and the rallies are going to be bigger. But that's still, in my opinion, probably another leg coming down in those airline stocks over the next year or so. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.